For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and health care? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
It sure is Managing Your Financial Future. Welcome back to the podcast. Johnny Dean, your podcast host, here with Professor Rick Plum, certified financial planner professional, and as if that were not enough, accredited wealth management advisor. I almost forgot that.
I also found out there might be another designation I might want to try to challenge again.
Didn't I ask you like a week or two ago, and you said you hated school, so you didn't want to have to do it, but now you're thinking there is one?
Yeah, I found out about it last week, and I was doing a little bit of a presentation about buckets to some people, and one of the guys there said that he was studying for his, now I'm trying to remember what it was called, the either registered or national Social Security advisor or something of that nature. But it's a Social Security designation.
Oh,
that you're
wow.
knowledgeable about social this abstract social construct or whatever called Social Security.
Yes.
I've heard of it.
You've heard of it. In fact, I'm glad you have, because since you mentioned that, I'm thinking we might as well talk about that today. How about that for a segue? That's pretty good. I would love to hear. I think that would be a great designation to have. I really do. And not that it would come in handy for you on this particular episode, because I think you got this nailed anyway. But, Rick, did you have any idea that your Social Security benefits and or the amount of the check that actually hits your bank account can be reduced for various reasons? Had you heard that?
Yeah, I think I've heard it through the grapevine. Yeah, they could mess with it, or you could mess with it. You can screw it up.
Sure. So we're going to be talking about
understanding the statement that you receive. You get the statement in the mail, or you go online, depending upon whether you've signed up for your My Social Security account or not. And you say, "What's going on with this benefit? It changes every month or so," and it does.
Yeah. Well, hopefully it goes up at some point, But so we're going to be talking about that. Now, we've said before that when you're putting together a financial plan, Rick, a bucket strategy, whatever it is, you've got to start with what we call the foundation, maybe foundational income, something that is not going to change, because you're not going to know how much you need to take from a portfolio until you know how much guaranteed cash flow you're going to have. And one of those things is the Social Security payments.
Yes, pensions, Social Security, things like that. Although there's a lot of people, and to be honest, I don't have an exact answer for this, but they're freaked out that, my Social Security may change in the future in 2032, 2033. I read the news all the time that it's going to go away. We'll see what happens, but we'll stay out of the weeds for this particular issue and say that Congress will get off their lazy backsides and actually do something so that they don't reduce grandma's or my Social Security benefit by 22 to 28%. 6 years from now.
Did you really want to get me started on that? Because that's not going to happen.
That's a discussion all to itself. We'll ignore that for the moment.
We're going to ignore that. That gets me fired up.
That's not one of the ways your Social Security might be reduced in the future that we're going to talk about today.
No, we're doing this today to talk about things that can happen today. So if we're talking about things like Social Security, obviously it provides, in some cases, it provides a big chunk of somebody's cash flow, somebody's income, or a relatively small amount. But it doesn't matter. You really don't want those benefits to be reduced if you can help it. So today we're going to be talking about some of these ways that your benefits can be reduced. Now, we covered this, I think, a couple years ago. Things have changed a little bit since then, Rick. The first thing that changed used to be that you could have your benefits reduced by what are called the windfall elimination provision and the government pension offset. You
got it right the first time.
The government pension offset, the WEP and the GPO, as they say, those were eliminated.
Those have been repealed as of 2024.
Yeah, that was the Social Security Fairness Act. And I think that was a good thing for everybody all around. So we're going to leave those out.
I just think it's interesting that the reason that those two things were in the code was because it wasn't fair. And so they put those in to make it more fair, back in 1983 or whatever it was. And now they're saying it's not fair to have them in. So the attitude towards what is or is not fair which is a 4-letter F word, by the way, has changed. Whatever.
It never was fair, but I think it's fairer now. Let's put it that way. Okay, so let's get to these things. There are 5 of them. There are probably more, but the 5 big ones. Rick, the first way that your benefits can be reduced, and again, when I say benefits, I'm talking about either the actual benefit amount or the amount that hits your check, or just your bank account. I just want to be clear on that. But the first way this actually does reduce your benefits, Rick, is claiming before full retirement age. Now, that's still a confusing thing for many people. Can you very quickly just explain full retirement age and the reduction or greater or a raise if you wait? Go ahead.
Well, if you look at that statement, I mentioned the statement that you get either in the mail or by going online at your My Social Security account. It shows you if you claim anywhere between 62 and age 70, what your benefit is projected to be at those given ages, and it goes up every year. Well, the reason it goes up is that Social Security is the payment that you receive is kind of actuarially derived in that they're agnostic as to when you take it. 62, 63, 70, 65, pick a number in there. Any month in between turning 62 and 70. They give you more per month if you start later, and they give you a reduced amount if you start earlier. Why? Because they expect you to die about the same time, regardless of when you take your Social Security. And so the payout to you is about the same over your expected lifetime. So obviously, if they're expecting to pay you X amount of dollars and you're spreading it from 62 to 82, that's over 20 years, they take X of, simple math here, X divided by, the number of months, and then they give you your benefit. But if you wait until 70, now they're only going to pay that same dollar amount out, basically, over 12 years instead of spreading it out over 20 years. If you spread it out over 12 instead of 20, you get a bigger payment.
Uh-huh.
Now, the only way you can game this system is tell me when you're going to die. If you know how long you're going to live, if you knew that you were not going to make it till, call it 82, 83, 84, taking it early makes sense because waiting to get a bigger check later does not have the time allowed to recover the missed payments in the early years. On the other hand, if you say, my parents are 90s and they're still taking care of their parents in 105, 120, whatever the number is, I'm going to make it to be 99 years old or more. Waiting to take your Social Security benefit, other things being equal, could make sense because while you give up early money, you more than recoup it over the multiple years that you're receiving the larger benefit later on. But it does take time, just from a very easy standpoint. If you started it at 62 and you were getting $2,000 a month, you've been getting $24,000 a year for 8 years. You get a nice little, and then that's nice. And if you die at 71, no matter how big that benefit is at 71, you didn't have time to recoup all those dollars that you made from 62 to 70. But if you live to be 90, you'll more than recoup the numbers. So
yeah,
it's just a matter of when do you take it? Yeah, it is reduced. They calculate your benefit based on your full retirement age. Full retirement age for most people that have not taken their benefit now, or for anybody who has not already reached full retirement age is going to be 67.
Mm-hmm.
So they calculate your actual benefit as of your full retirement age. That's your benefit. Boom. That's your baseline. Now, if you start taking it early, before full retirement age, they reduce it. How much do they reduce it? It's a weird formula. Don't worry. They do. Basically, if you take it at 62, it's a 30% reduction. And it's a different number all the way from 62 to 67 now.
Mm-hmm.
If you delay, you do not take it at 67, your full retirement age, or whatever your full retirement age was, you get an increase, and it goes by the months. Not the number of years you wait. It goes by the number of months you delay. Same thing if you take it early. It's not based on the number of years you take it early. It's based on the number of months that you take it early. So you don't have to wait a full year to get the full, what they call 8% delayed retirement credit. That's 2/3% per month that you wait. So it can go up if you delay it. It can go down if you take it early. And that's where we have to play the idea of What are you willing to bet your life expectancy is?
I got to tell you, I've found more cases to take it early, personally. Just from my own research, and it doesn't even necessarily involve math, and I think we've talked about that before. In fact, one of the things that we've discussed in the past, we're going to bring up as one of the reasons it can be reduced, but we'll get to that in just a bit. So claiming before full retirement age, which is the most, I think, readily apparent to people, if they understand anything about Social Security, that the benefits are going to be reduced. I think most people understand that. So that's one way it can be reduced of the 5. Now, the second one...
I have one quick thing here. Mm-hmm. People are saying that they want to take it early so that they want to get as much as they can before they reduce the benefit in 2033. I know you don't want to talk about it. But the reality is the math's still going to work out, because if they do reduce it in 2033, they're going to reduce your reduced benefit more, and they're going to reduce the other benefit. Both your benefits are going to get reduced. Whether you took it late or we took it early, it's still going to get reduced, and they're proportional numbers, and the math will still work out. If you live long enough, it's one way. If you don't live long enough, it's the other way.
Well, good. That's true, and that's from the mathematical point of view there, and the logical point of view. I will say no more about that. Maybe in a future program I can explain how government payments actually work. They cannot possibly run out of money. Okay, that's the first one. The second way it can be reduced is through Medicare premiums and the potential of what we call IRMAA, IRMAA, the Income-Related Monthly Adjustment Amount. Rick, talk about those two things.
Well, this has to do with the deposit that you get put into your bank account each month. Because Medicare and Social Security are very closely linked together, they take out the Medicare premium from your benefit automatically, and you get the net amount deposited into your bank account. Mm-hmm. So you may be seeing a deposit of $27.96.90, but your real benefit was $3,000 a month, but the Medicare premium was taken out ahead of it. Now, what happens, though, is if your income goes over certain thresholds, and this is a tough one because they don't use your current income. They typically use the income that you did or you showed on your tax return 2 years ago. If, as a single individual, your income 2 years ago was over $109,000, you get the privilege of paying more for your Medicare premium, and they don't ask. They just take, and so they reduce the deposit. They automatically just take more from your check, your benefit, because and they give you the net amount. So depending upon where your income was 2 years before, you may be subject to IRMAA or you may not. If you're not, you get you get the normal Medicare premium reduced. If it was really, really high, your Medicare premium could be almost $690 per month per person on Medicare in your household. So instead of $202.90, you pay $689.90. That's a big increase. Or it could be scaled in, all across the way. As a single individual, your income had to be over $500,000 to pay that $689 number. But you've got thresholds all the way up, which increases it incrementally. 202, 285, 406, 427, 650, 690. I mean, it just keeps going up. So those will automatically reduce the deposit to your bank account.
Yeah, it's and this is one that really takes a lot of people by surprise because they may have forgotten. They didn't know. They what do you mean? I sold that house 2 years ago or whatever it is. A lot of times I guess it's a big capital gain, Rick, like a sale of a home that you wound up paying taxes on.
That's a common one. Yeah. That's a common one. Sale of a home, an unexpected gain, or you inherited an IRA and you decided just to cash it out in the first year for $100,000, and it popped your income up quite a bit. Stuff happens. It's a nice thing when it happens, but you get a little surprise 2 years later, or basically in October, November of a year following, almost 2 years later, you get a letter saying, "Oh, by the way, next year your Medicare premiums are going to go from $202.90 to $527.50 for the year." Well, if you had a one-time life-changing event, death in the family, a marriage, retirement, such as those kinds of things, you can ask them to not look at the 2-year prior income level and rather look at this year's income level. So you can get away from it if you had a life-changing event. Like I retired. Okay, when I was working, I was making beaucoup bucks, and now I'm retired and I'm not making anywhere near as much. I don't want it to be set on my pre-retirement earnings. I want it to be set on my retirement earnings. And they will accept that.
I wonder how many people actually know that. These things are really confusing, and if you're not working with somebody who understands all this stuff, like Professor Plum, you could find yourself.
You may not know it right away, but when it happens to you, you start bitching about it, and somebody will tell you, "Oh, you can get away from that because you retired." I mean, there's enough people that know about it that when you start complaining, and trust me, when it happens the first time to people, it's complained about.
So in other words, don't suffer in silence, as they say.
In some things, yes.
Yes, in this particular case. All right, so that's another way it can be. And again, I think many people, maybe not as many as understand that claiming early gives you lower benefits, but I think many people do get that the Medicare premiums are taken out, and those Medicare premiums do tend to go up each year. I think most years they have gone up, so that could potentially reduce part of your benefit. But then if you get a COLA, so, those benefits are going to change.
It was interesting several years back when we had zero COLAs on Social Security. That's about 8 years ago or so. We had 2 years in a row where we had no cost of living allowance on it. The Medicare premium that did go up each of those years was not allowed to eat into your net payment. So let's just make easy math. I was getting $2,000 a month, and Medicare was $200 a month, so my net payment was $1,800. The next year, my COLA was zero, so my benefit's still $2,000 a month, but the Medicare went up to $220, went up 10%. They will not reduce my deposit at that point just because the Medicare ate up all my cost of living.
That's a rule, by the way.
Right. But if I triggered IRMA, they'll take it all.
Yeah, that's a whole different kettle of squid. But the rule is just on a normal Medicare increase, it cannot lower your net benefit. That's another thing people don't know.
And most of the time, even though we only get a 2 or 3% cost of living allowance on our benefit, that generally is more than enough to cover what could be as much as a 10% increase on my Medicare premium. And so when we hear about a 2.8, 2.9, 3% increase, and sometimes it just doesn't feel like that big of an increase in our benefit check when we see it deposited, that's because the Medicare ate up a lot of that COLA.
Yeah.
But it's not allowed to go negative on your COLA unless you're in IRMA.
Good to know. Okay, so that's just two things: claiming before full retirement age and Medicare premiums / IRMA. The third way, this is another one that people don't always know, is it can be reduced if you're working while you claim before full retirement age. Rick, talk about what happens when you make more than a certain amount of money before you actually reach your full retirement age.
Well, this has to do with what they call the retirement earnings test, and it affects every benefit the same way, except for disability. It doesn't matter whether you're getting a spousal retirement benefit, your own retirement benefit, a widow's benefit, a survivor benefit, whatever your family benefit, whatever you want to call it. If you are under full retirement age, and that's why it was important for a long time to actually know what your full retirement age was, still is, although it's becoming easier because, as I said earlier, almost everybody who has not reached their full retirement age will be 67 starting next year unless they change the rules again. It's just a matter of if you continue to work prior to full retirement age and you make more than certain thresholds of income. And this only has to do with earned income, W-2 wages, net self-employment income. Basically, not exactly, but basically income that you're paying Medicare and FICA premiums on. If you're doing, then they're going to say you're not retired. You are not eligible for all or any of your potential retirement benefit at this time. And what they're going to do is they're going to give you a test. Now, and this is they do grade it on a scale at times, but it basically says how much did you earn in the year that you were receiving Social Security benefits and you were under full retirement age for the entire year. If your earnings exceed, and this is the number for this year, 2026, $24,480. Let's just call it $25,000. If your earnings exceed that threshold, we are going to ask back. We want you to pay back. You are ineligible for retirement benefits equal to, we're going to take back $1 of benefits for every $2 of earnings you had over that threshold. So if you're at $49,000 of earnings, you're $24,000 over the threshold. They're going to take back $12,000 of your benefit. They usually don't catch it right away. They usually catch it a year or so later when they match up what they've paid to you and the tax returns are being filed and put in play. And then they'll send you the little nastygram that says, oh, remember 2 years ago when you were getting that, $2,000 a month or whatever it was, in Social Security? You were still working. You were not eligible for all that. You made $100,000. You made too much money. We want that money back. Mm-hmm. So you can write a check made payable to me or to the U.S. Treasury for the $24,000, whatever the number is, and we'll call it even. And we won't send you any benefits until you reach your full retirement age, or until you prove to us that you've quit working again, which is a pain. But if you are working and you're under full retirement age for the entire year, there is this just under $25,000 threshold that you start losing your benefits if you continue working. Now, this is often confused with the taxability of Social Security, but it's a totally separate game. Totally separate. It has nothing to do with the taxability of your benefits. This is, you are not entitled to the benefit. Give it back. That's the penalty for the years before you get to full retirement age. It's pretty straightforward. How much did you make? 1 for 2 above that, give it back. But in the year that you reach your full retirement age, it's a different kind of wonky look. They only look at the months of earnings that you had prior to full retirement age. They don't look, so if somebody's making $120,000 a year, they're looking at how much did you make before you hit full retirement age. If your birthday is in March, they're only looking at 2 months of earnings. If your birthday's in December, sorry, they're looking at 11 months of earnings. And so it's going to affect. But the threshold is significantly higher. It's a little over $65,000. So you can earn $65,000 in those months prior to your full retirement age and not give any of your Social Security back. So if you're making that $120,000 a year and your birthday's in July, you could say, well, I'm going to start taking my benefit in January of that year. It's a little bit reduced, but I want to get it while I'm still working. Because in the months prior to my birthday, the 6 months prior to my birthday, I'm only going to earn $60,000, which is under the threshold, which means I don't have to give any of it back. Got to play the game. Got to know the rules to play the game right, though. But this is one of those ones where if you start too early, and it's not one where they're going to reduce your benefit. It's not like they're just going to call you and say, we want it back. They're not going to call you, excuse me. They're going to send you a letter. And they just want you to pay it back.
Simple stuff, right? I mean, this is why we're talking about this. I know there's a lot of information here, and there's certain things that happen in the years before you turn full retirement age, and then in the year you do turn full retirement age. But these are ways that can be reduced, and this working before your full retirement age takes some people by surprise. Rick, we don't have a ton of time, but I want to cover these last two if we can. The fourth way that your benefit can be reduced is on taxation. Now, we could spend a whole show talking about this. And the taxable nature of Social Security benefits changed. Was it this year? Last year? I forget. Depending on different things. But taxation of benefits, unless you're withholding, you aren't going to notice this until you actually file your return.
Well, I mean, the question is, will my Social Security benefits be taxable? And then once we determine whether they are or they are not taxable, assuming they are taxable, where is that tax going to be paid from? We can withhold it from our checks. We can withhold it from our Social Security benefit checks. But the idea is Social Security may be taxable, and is taxable for most people nowadays, not everybody. But they basically use what they call a provisional income. They look at all the taxable income on your tax return and half of the total Social Security benefit you receive. Not the net benefit that's paid into your bank account, but the total benefit that's paid before the reduction for Medicare. They use half of that number. That's your provisional income. All the taxable income on your tax return, all the tax-free municipal bond interest on your tax return, and half of the Social Security. If that number exceeds certain thresholds, then some of your benefit will become taxable. It starts off at a fairly benign rate at 50% of the excess over the threshold, and then ramps up to 85% of the amount over the threshold until you reach a maximum point of 85% of your Social Security benefit. So at the worst case today, 85% of your Social Security could become taxable. It's not an 85% tax rate. It's It's an 85% inclusion rate into the taxable income. So if I'm making $20,000, $17,000 potentially could be taxable on my tax bracket. So whatever I'm paying, it is ramped up. So it depends on what you're receiving in Social Security and other income, and it's different. One married couple may have $80,000 of total income, and have none of their Social Security being taxable because they've got a combined $60,000 of Social Security and $20,000 of IRA distributions. They don't have hardly any tax. They don't have any taxation really. Whereas the other couple has $80,000 of income, but it's $20,000 from Social Security and $60,000 from IRA distributions. They've got a much bigger tax bill because 85% of their Social Security is taxable and $60,000 from the IRA is taxable. So they got a big chunk of a decent amount of taxable income versus the other person that had no taxable income, even though their total household income was the same. It's all about the other income.
Yeah, it's other income and half of the Social Security income.
And unlike the retirement earnings test where we only looked at earned income, W-2 and things like that, this is looking at all income, including capital gains, which may be in a 0% income tax rate. You may have capital gains on your tax return that you don't pay taxes on because you're under the threshold for you're in the 0% capital gain, long-term capital gain bracket. But that long-term capital gain is part of your adjusted gross income, which is part of your provisional income, which may affect your Social Security. So that $10,000 of capital gain, long-term capital gain, you say, well, I'm under the threshold. I don't owe any taxes on it. Why did my taxes go up? That's because $8,500 of Social Security became taxable. That wasn't taxable before, and you got to pay tax on that.
Oh, you see how easy this is? I know we like to, Rick, you like to tell people everything you know about this, and this is a good thing because this is all going to matter for people at some point. But I understand it's complicated, which is why it helps to have somebody who understands Social Security help you out. So taxation, that's a fourth way it can be reduced. Let's get to the last one here because we only have a couple minutes left of time. But we've talked about this on previous shows, but it's an important thing to understand. If you're married and you've got two Social Security benefits and a spouse dies, Rick, one of those Social Security benefits goes away.
Right, you don't unfortunately get to stack both of them on top of each other and continue the same income. Yes, you may be eligible for a survivor benefit equal to what that decedent was receiving. Yes, you are eligible for your own retirement benefit. No, you are not eligible to both of them on top of each other all the way. There may be, so if you've got one spouse getting $3,000 a month and one spouse getting $2,000 a month, and let's say they're both over full retirement age, so we're not going to play these games. When one of them passes away, the lower of the two benefits disappears. The survivor will only be able to maintain that higher benefit, in this case, the $3,000. So what they were getting $5,000 a month, now they're only going to get $3,000 a month. And there's nothing you can do about it.
Well, and this is most pronounced when you have two spouses with equal Social Security benefits.
Or similar, yeah.
Or very similar Social Security benefits. If you have one that's making, that gets $3,800 a month and one that's getting $900 or $1,000 a month, I mean, it's the drop-off is not as harsh as it is if you have two spouses that have very similar benefits.
Yeah, so if you've got one that waited till 70 and one that took it at 62, you may have a $5,000 benefit and a $1,000 benefit. I don't know I don't think we could have that big of a disparity, but let's say in that case you're getting $6,000 a month, but you're only going to lose $1,000 of it or so. Whereas compare that to somebody who both of them are getting $3,000 a month, so they're getting $6,000 a month combined. But when one of them dies, one of the $3,000s drops off, and they get basically cut in half.
Yeah, it's something that most of these things, I think, take people by surprise. And this is why we're talking about things like that. If you want to know more about that reduction in spousal benefits and all that stuff, as I said, we have a previous episode. We could talk about more of these things. Each one of these things could almost be a standalone topic, Rick. I know there's even more to say about some of these things that you're talking about. But what's important to understand is that your benefits, your Social Security benefits, can be reduced. In some cases, it can be significantly reduced, as in the example we just saw, or you may wind up having to pay back certain benefits. It just kind of depends on what your individual situation is. But since these kinds of things can make a difference in your planning, the foundational aspect of your financial plan that we talked about here at the beginning of the episode, you need to understand whether or not these benefits for you are going to ultimately be reduced, potentially. And if they are, is there a way to avoid it, or at least be prepared for it? If you want to talk through your own Social Security strategy, or how it fits into your retirement income plan, as it probably does, you can talk with the advisors at Lucia Capital Group. Their phone number, 800-644-1150, 800-644-1150. You can also visit online, luciacap.com, LUCIACAP.com. We do have those guides. One of them is a Social Security guide. I believe it's updated, but even if it's not necessarily for the years and the amounts, the laws and the rules are still the same. Check it out. You can type in Social Security Guide into the search bar and download it and read it. I would highly suggest you do that. Have you checked that, by the way, Rick?
I haven't checked it lately. I was just thinking, I wonder if we've updated it for the Social Security Fairness Act. I'm hoping we have.
I think we better take a look. Maybe some of that's out of date. I don't know. These guides are so hard to keep up to date, but we do our best to do that. So we'll take a look at that. Anyway, you can get those. We also have a bucket strategy guide, retirement income, estate planning, rollovers, and much, much more. Okay. Oh, that's right. Subscribe. Make sure you subscribe. Managing Your Financial Future. Of course, that's the title on Apple Podcasts or Spotify. So each new episode shows up automatically in your feed, and you can just listen to your heart's content. That's wonderful. We are out of time. My thanks to Professor Rick Plum, certified financial planner professional and accredited wealth management advisor. I am your podcast host, Johnny Dean. Thanks so much for listening. We'll talk with you all again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59 and a half may also be subject to a 10% penalty tax. Municipal bond interest may be subject to the alternative minimum tax. The information provided is based on current laws which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.